Hello guys, welcome to i-tutor Academy. In today's session, we will start with Unit 13, that is Ratio Analysis of MMBC 004. So let's see the objectives of this chapter. Objectives are understand the meaning and rationale of ratio analysis, provide a broad classification of ratios, identify ratios which are appropriate for control of particular activity, discuss and interpret various ratios. And structure of this chapter are there is an introduction part and type of ratio, profitability ratios, liquidity ratio, leverage ratio, coverage ratio, efficiency or activity ratio, investment ratio or valuation ratio. Summary is there, keywords are there, self assessment questions also there. So let's begin with the introduction part. The financial information relating to any business firm is included in the three fundamental financial statement, that is the balance sheet, income statement, that is a profit and loss account, and cash flow statement. The balance sheet focuses on the resources or assets that are at the firm's disposal and the obligations or liabilities of the business firm. It is thus a statement of what the firm owns and what the firm owes us on a particular date. The balance sheet is a snapshot of the assets and liabilities of the firm at a point in time. The income statement summarizes the revenues earned, the expenses incurred to earn those revenues, and finally, the profit generates or losses incurred during an accounting year. The profit is the surplus of revenues over the expenses incurred. It thus depicts the profitability position of a firm during an accounting period. The third financial statement prepared is the cash flow statement, which reflects the sources and uses of cash or the flow of cash during an accounting period. It is also called the statement of changes in financial position. These financial statements summarize the transaction carried by a business enterprise over an accounting period in financial terms. These financial statements need to be analyzed to gain better insight into the strength and weakness of the firm. Such an analysis is undertaken by establishing relationship between different item or balance sheet, income statement and cash flow statement. Besides the management, other stakeholders interested in such as analysis are the shareholders, prospective investors, creditors, customers, suppliers, lenders, and the government. Shareholders and the prospective investor want to know if the money they have invested or intended to invest would grow in value over a period of time or not. Creditors who have lent funds want to know if the money they have lent to the firm is safe or not. Even employees who work for the firm want to know if the company is profitable or not so that they receive the compensation and other benefits regularly. The government also wants to know if the firm would be able to pay taxes or not. One of the ways to find answers to such concern is by conducting a ratio analysis. Ratio analysis is an important tool used in the analysis of financial statements. A ratio is simply the relationship between any two or more things. In the context of financial statements, when any two or more item of the financial statements are expressed as a ratio, it is called a financial ratio. We can comment on the performance of a student only when the marks obtained by him are seen in conjunction with the maximum marks. Similarly, to evaluate the performance of a firm, say in terms of its profit, just knowing the quantum of profit earned by the firm is not enough. We can comment on the performance only when the profit are compared with either the investment made or the sales. And type of ratios, any business has many stakeholders. Different stakeholders in a business firm want to evaluate the financial performance of firms from their perspective. Shareholders or the owners want to evaluate if the business enterprises is profitable and financially strong or not. They want to know if the money invested by them has grown over the years or has the investment eroded. Short-term creditors and suppliers of raw materials want to know if the company would be able to repay the short-term credit which they have provided. They are therefore interested in knowing about the short-term liquidity position of the firm. Similarly, lenders of long-term finance are interested in the long-term solvency and profitability of the firm. Management is interested in the overall performance of the firm. Thus, each shareholders want to examine and evaluate the financial statement from their perspective. Thus, we may categorize the financial ratios in the following categories. There is type of financial ratios. First one is profitability ratio, liquidity ratio, leverage ratio, coverage ratio, efficiency ratio, and valuation ratios are there. As the name suggested, the profitability ratio assesses the firm on its profit earning capacity. So here is there is a the discussed detail which the following balance sheet and the income statement of a hypothetical firm are considered. So here is an example, you just go through it, so it will be more clear for this section, and in case any doubt you can contact us. Profitability ratios. Profit is the surplus of the revenue earned by a firm by selling its product or service over the cost incurred to produce those products or rendered the service. It is imperative for a firm to earn profit to sustain its operation in the future and reward its shareholders who have invested their funds in the firm. Creditors would also like to see the firm to whom they have provided funds to make profit, so that the firm is in a position to repay the loan and pay interest as promised. Employees and workers would want the company to be earning profit so that they receive salary and incentives regularly and on time. So gross profit margin is equal to sales minus cost of goods sold, that is equal to gross profit divided by sales revenue. So gross profit margin assesses the efficiency with which the firm produced its product. A higher gross profit margin implies that the firm is able to generate better price for its output, produce good at relatively lower cost, or both. And net profit margin is equal to profit after taxes, that is, or net profit divided by sales revenue. Like the gross profit margin, the net profit margin also indicate the overall efficiency of the management from producing the goods to selling them. Both the gross profit margin and the net profit margin need to be evaluated in the combination which with each other. Consider a situation where although the gross margin has been increasing over the years, the net profit margin is not increasing at the same rate, and the net operating profit margin is equal to, that is no PAT, divided by sales revenue. EBITDA margins relates the earning before interest, taxes, depreciation, and amortization to be sales of the firm. As mentioned earlier, EBITDA is a broader measure of profit. It is usually considered as a proxy estimate of the cash profit from the operation, as it excluded interest, taxes, and even depreciation and other non-cash items. And EBITDA margin is equal to EBITDA divided by sales revenue. So far, we have compared different measures of profit: gross profit, net profit, operating profit, and EBITDA with the sales revenue of the firm. Profit may also be compared with the investment made by the different suppliers of funds, equity shareholders, and debt holders. And return on asset relates the NOPAT with the total asset. And NOPAT, as I defined earlier, so you just refer that. And return on asset, that is ROA, is equal to NOPAT divided by total asset. So these are the equation. You just don't by heart, you just understand that, then you can write your own words on term and examination if question asked from this section. Total asset EBITDA is a wider measure of profit and is usually considered as proxy estimate of the cash profit from the operation, as it excludes interest, taxes, and even depreciation and other non-cash items. Return on capital employed, ROCE, relates NOPAT with the amount of fund, both debt and equity. And ROCE may also be calculated on the pre-tax basis as follows: return on capital employee is equal to EBIT divided by total debt plus shareholders fund. And return on equity, ROE, relate the profit after taxes with the funds provided by shareholders. Profit after tax divided by shareholders fund. The shareholders fund or net worth consists of paid up equity, capital, and reserve and surplus, that is net of accumulated loss if any. Paid up equity capital is the funds that has been invested by the equity shareholders, while reserves and surpluses are the retained earning that belong to the equity shareholders. Okay. And earning per share, that is EPS, and dividend per share, EPS, dividend dividend pay, and dividend yield. And these are the equation, you just go through it and just read your Ignou study material, MMBC 004 unit 30. Okay. And liquidity ratio. Creditors in particular are concerned about the firm ability to pay their dues. Therefore, they try to analyze the liquidity position of the firm with respect to current asset and current liabilities. That is to know if the firm's current assets are adequate to pay off their current liabilities. This is assessed by comparing the current asset with the current liabilities. If a firm is unable to meet its current obligation due to lack of liquidity, it will result in poor creditworthiness, loss of business reputation, and in extreme cases legal action against the firm. At the same time, a high level of liquidity would mean that the funds are invested in low yielding current asset. Therefore, a proper trade-off must be maintained between too low and too high liquidity in the business. Current ratio is equal to current asset divided by current liability, and quick ratio is equal to current asset minus inventory divided by current liability, and cash ratio and cash and bank balance and short the term invest minus term investments divided by current liabilities. Okay, so these are the equation and these are the definitions of each, and you just go through your Ignou study material and just read the chapter and it will be more clear. And if you have any doubt, you just contact us. And this is for today's section. For more videos, you just like, share, and subscribe our channel and support us. Thank you so much.
i-tutor ES presents Ignou MBA complete syllabus coverage classes and individual semester base subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.